Welcome to this edition of Investment Insights. Today we have James Wilson with us. Welcome, James.
Thank you, Natasha. It's good to be here.
We have seen investment markets being impacted by the US administration's influence on current trade wars. What are you seeing play out in the stock market?
Well, it feels like it's been a while since we've spoken about trade wars, but they are not new and they are back. Now, put simply, tariffs raise the costs of doing business. And in response, companies may attempt to transfer the increased costs to consumers, which could also contribute to inflation. However, the ability to do so differs among businesses. If a company is unable to raise prices, the higher costs may negatively impact their profits. So it's no surprise that the reaction has been negative across the board from investors, businesses and consumers. And this became quite pronounced on the 3rd of April when Trump announced Liberation Day in the US, and the announced tariffs caused the worst day for the S&P 500 and the NASDAQ since COVID-19. Now, initially when tariffs were announced, there was some uncertainty whether these would actually be implemented, as Trump tends to use tariffs as a negotiation tool. And recently we have seen signs of this, with the White House pausing reciprocal tariffs on some countries that were willing to negotiate with the US. But in general, it appears that this time, Trump was very serious about implementing the announced tariffs, taking a very hard line on China in particular. So stock markets have been extremely volatile as a result of these events. And when comparing the volatility seen in markets when Trump was re-elected last year, compared to his first 100 days of his first presidency, markets have been a lot more volatile. It's an evolving situation and will likely be for some time.
So, what does this mean for us in New Zealand?
Well, it is a trade war, and there are countries named the worst offenders which come with a higher tariff such as China. But New Zealand isn't completely immune either, with a baseline 10% tariff. But I would say it seems fair to say that we're more insulated relative to other countries. However, this insulation hasn't seemed to have stopped the negative sentiment spilling over to the New Zealand share market, which is down around 8% this year. Now, the one key company to watch would be Fisher & Paykel Healthcare. With 60% of its products manufactured in Mexico and sold to the US, the company is also the largest in the New Zealand index.
While tariffs have been dominating the news, not so long ago the focus has been on the launch of DeepSeek and the resulting volatility in the AI tech space affecting investor sentiment. Could you tell us more about that?
Yes, of course, DeepSeek. So, just to set the scene, a large part of the share market gains over the last 2 years were driven by the promise of artificial intelligence, and it was only those companies that were willing and able to spend tens of billions on this technology were set to capture it. Hence, the group of mega-cap US companies which became known as the Magnificent Seven. Now, with that in mind, here comes DeepSeek. DeepSeek is a private Chinese company, an artificial intelligence startup who came to the market with an offering that was claimed to be just as good as ChatGPT. But not just that. They did it by using less advanced computer chips, less advanced computing power, and at a fraction of the cost. Now, there does exist some uncertainty over the accuracy of this claim, but what it has done is call into question the immense amount of money being spent on AI by the Magnificent Seven. And we're talking something around $260 billion US expecting to be spent on AI this year in 2025. So on the day DeepSeek made its announcement, we saw Nvidia shed $600 billion US in a single day, which is a record. And in general, we saw a lot more volatility from the biggest names in the index. However, while DeepSeek was introduced, yes, investors did pull back from other large US companies in this space, but we didn't see broad-based selling. In fact, the vast majority of companies in the S&P 500 actually went up in value on that day. So investors more or less rebalanced into other sectors, which I think shows signs of a healthy market. So it seems to be the tariffs driving most of the volatility at the moment.
As we look into the future, what potential challenges should investors be aware of?
Yeah, look, one challenge we'll be keeping a close eye on is what happens to inflation and global growth. This new US government policy, not just tariffs, but also immigration, has the potential to raise inflation and keep interest rates higher than what we might expect. And also, it has the potential to slow down global GDP. And then there become indirect impacts of this as well, such as how it affects business and consumer confidence. Because markets don't like uncertainty any more than you or I do, which then can result in market weakness.
Let's leave it on a good note. What emerging opportunities do you see in the market?
Yeah, well, we kind of need to squint through the clouds a little bit right now, but one would be more attractive valuations from the US. So with a pullback in this market, companies which were expensive can now be purchased at more attractive valuations. So let's not forget that going into this sell-off, the US share market had extremely high valuations. Other areas we expect to show more signs of life would be the global listed property market. Now this is an asset class that historically tends to have really strong operating fundamentals like high occupancy rates, valuations are also really supportive, and it's also an asset class relatively insulated from trade tensions and potential disruptions from the likes of DeepSeek and other emerging artificial intelligence providers. So as an investor, it will be important not to panic and to seek professional advice before actioning any changes to your investment.
Thanks, James. And thank you for tuning into this edition of Investment Insights.